Okay, everyone, welcome back from lunch. So good to see the room so busy so quickly as we come into the last parts of the show today. So we have our last fireside discussion here on stage 2, and this is what I've been looking forward to because I think there's an awful lot we can actually dig into this with. We're joined by Cornelia Anderson, Head of Sustainable Finance Data and Analytics at London Stock Exchange Group. A round of applause for Cornelia, please. See, they're a nice bunch. They clap when you ask them. It's great. Okay, well, if we're digging into sustainable finance, let's start at the very obvious place. When we're talking about it, what do we mean by it? How do you define it?
That's a very good question. And in fact, the very same question as the Uber driver asked me on the way here today. So sustainable finance, it's a concept that I think, in previous years, it's been a little bit theoretical, right? As many areas of sustainability to at least the broader general public. What it actually means is the allocation of capital to sustainable assets. That could be companies, it can be infrastructure projects, it can be securities, and that's a very, very fundamental, important part of financial markets, right? So that allocation of capital is something that impacts, obviously, asset owners and investors, also the asset managers out there, banks and financial advisory firms, and then ultimately at the end of the day, the owners of those assets, right? So whether those are corporates or other institutions. So that is my take on sustainable finance. And
when it comes to the challenges about it, what are the biggest challenges when it comes to adopting that kind of method?
So it's a good question, right? And I think there's a couple of challenges which I think are very common to many areas of sustainability. The first one is really around awareness and education and understanding what does this mean? What is the real business impact, importantly, of engaging with sustainable investment strategies or risk management processes? And a lot of those hurdles today, I think, come from a lack of understanding that the world, whether we're talking about the physical climate, whether we're talking about financial markets or regulation, is fundamentally changing. There is what I would think of as a paradigm shift happening out there, which is largely driven by the physical impact of climate change. And then if we kind of take it back to financial markets, there is a very significant body of regulation across the world in all major markets that's focused on changing the way that funds operate, that investors operate, and shifting that towards more sustainable practices.
So if one of the biggest challenges is that education and that knowledge, how is that being addressed and how successful are those operations at the moment?
Yeah, so that's done in a few different ways, right? And I think this is probably an area where all larger businesses should lean into this, right? And engage with customers and the marketplaces around this. So if we think about, financial markets as a whole, right? There's a spectrum of actors or players. On one end, you have investors and asset owners. So these are typically very large, sophisticated institutional investors. And we're talking about things like large pension funds, large institutional asset owners. Then the next group is asset managers. And here we have many very large companies, such as the BlackRocks and the Vanguards and so on in the world. And then if we continue along this spectrum, you then have financial intermediaries, so banks, but also consulting firms, advisory firms. And at the other end of the spectrum, you have corporates and government institutions and so on. And across the spectrum, there's a very differing level of maturity and understanding. So when we talk about upskilling initiatives and capacity building, you need to recognize where on the spectrum you are, and then you have to tailor the initiatives according to that. I think one of the things that's very important to recognize is that, in financial markets, we talk a lot about capital of different kinds. And there isn't just one kind of capital. There's obviously financial capital. We also have intellectual capital. We have natural capital. And importantly, we have human capital, right? And that human capital is really the key to success in sustainability. So that's why some of these education efforts are so important. And again, they look very different in different parts of the world as well. Some regions are much more aware of sustainability. I think it's, even just in Europe, right? If you walk down the street and say somewhere like Scandinavia, and I'll share an anecdote. I was in Sweden over the summer. and went into the local burger chain called Max Burgers. I don't know if you ever tried, they're pretty good. But when you walk into Max restaurant, you have the menus displayed, and each one of them spells out the climate impact. And the kind of the big selling point is that all of their menus are climate positive. For a hamburger chain, right? Walk down, the high street in Georgia in the US, that's not the experience you're gonna have. So I think it's important to recognize that not one size fits all, and particularly when it comes to education, you need to be really aware of what is the local context that you're playing into.
Because from an outsider's view looking into the world of finance, you imagine it being, it can be quite a tough environment because people are there to make money and to get returns and that sort of thing. Does that make it a difficult sell? Is it becoming an easier thing to get people to buy into?
Yeah, look, we've seen, I think, what I would call, reaching the next level of maturity. So I think sustainable finance in particular is at a bit of a crossroads, right? So if you think back a few years, it was all guns blazing, everyone's doing sustainability one kind or another. I think we now reached a level of maturity where some tough questions are being asked, and probably rightly so, around does this actually make sense? Do we have the data to prove that we're having the impact we thought we had? Are we seeing the returns that we thought we would? And that process in some parts of the world, particularly again the US, has led to a little bit of a retraction, I think. So there's fundamentally, I think it's a very healthy and a very good process that we need to go through. It's an emerging space. It's also, if we talk about the data side of a little bit, right? So the basis for all decision making in financial services is data, right? If you're going to make calls on how you're going to invest capital, how you're going to manage risks, if you're assessing returns, you need good data for that. And the data around sustainability, and I'm using that term very broadly, is emerging still, right? So I think it's right that we're kind of taking a little bit of a pause and asking some tough questions. But having said that, the numbers and the trend and the appetite for investing in sustainability is huge, right? So we look at allocation over the last sort of 10 years or so, let's grow tenfold. The size of the sustainability finance markets are much, much bigger now. And investors, 90% of investors today are actively engaging in sustainable investment strategies. So it's sort of, I think it's a healthy and a good process of the next level of maturity there.
Because one accusation could be people are only getting involved in it to tick a box, to that kind of thing. Is that a myth now, or do you feel that's fading now? It's actually having a tangible impact.
So I think the answer is actually both to that, right? So there's no doubt that sustainable finance and investing is having a tangible impact, and there's plenty of studies that can demonstrate that there are actually very solid link between returns and also between, importantly, building better businesses. There are certainly still in plenty of quarters individuals who look at this as something that's perhaps more of a tick box exercise. But there's a big shift in understanding the importance of sustainability. Some of that is driven by regulation, as I alluded to earlier. And some of it, I think, is driven by actually seeing the impact in the markets and really the growth of the green economy. So I'll talk a little bit about the growth of the green economy. So we try to, at the London Stock Exchange, we try to measure and understand what is actually the size of the sustainable economy. And it actually works out, if you measure it based on publicly listed companies, about 7% of global market cap today. If it was an industry sector, it would be the fourth largest industry sector. So we use a fairly sophisticated framework where we look at how do companies make their money, right? So what proportion of revenues come from sustainable products and services? And that has been a phenomenal growth journey over the last couple of years. And I think we can probably all think of companies that have come out of this industry. Tesla is always the poster child there. And I think it's very important to demonstrate that there is a real growth opportunity here, and sustainability is no longer about managing risks, it's about setting yourself up for growth in this new economy.
That's a very good way of phrasing it, actually, and setting yourself up for what comes next. And that does lead me to my next question, so thank you very much. And that is, what are those biggest opportunities that come next? Where are the areas where there is the growth from sustainable finance?
Yeah, good question. It's so we think about what the world needs to be able to hit net zero roughly around 2050. Again, there's lots of studies on this, but probably in average numbers, about $100 trillion by 2050. And that will largely have to be put into infrastructure, into energy. It would also have to go into the high emitting industries today, such as shipping accounts for probably about 2% of global emissions. Transportation is another one. So those areas will absolutely be on the recipients of significant amounts of funding, for sure. Then I think if you think about, beyond sort of infrastructure and industrial sectors. In the services industry, there's a huge amount of demand for any kind of consulting or advisory in the space, huge amount of demand for data and analytics, and really for smarter technology that helps us all make better decisions.
Looking to the future of the industry, though, how do you feel it's going to shape the future of finance? Do you feel it's something that's just going to continue to grow? Is it plateauing? Where do you feel it's sitting now?
So I think the shift to sustainability will very significantly change financial markets and also how we all do business today, right? So, probably sort of 5-10 years ago, sustainability would be something that existed in a silo, in a separate team somewhere. You would do, a CSR report on its own. That's changing, right? So today, if you talk to a portfolio manager, he or she will absolutely be reporting on the temperature alignment of their portfolio and the ESG scoring of their portfolio. If you talk to an investment banker, he or she will be including, a view on sustainability in the pitch decks that they put together. So with time, I think we'll see quite a fundamental change here.
Because as the next generation of financiers sort of come through, do you feel they will be far more receptive, knowing that the sustainable finance market is an integral part of it? It's not in a silo.
Yes, I think so, right? For a few different reasons. One is that they've grown up in a different world and they will be growing up with the impacts of climate change in a very different way compared to the rest of us. I think with a much better understanding of the scarcity of natural resources and the value of those. My experience as well, having worked with lots of junior bankers in particular over the years, is that they're technologically much more savvy, right? So they come out of business school being able to code, for example. And that means that you can then more easily make use of and engage with these new types of data sets and processes, which may be a little bit theoretical for some of us older folk.
I've talked a lot over the last 2 days about sort of the carrot and the stick when it comes to regulation or involvement from other organisations to make these things happen. Do you think there maybe should be a greater push, or do you think there might be a greater push to actually make this an essential part of people's strategies?
Yes, yes is the short answer to that, right? So we certainly advocate actively with regulators across the world for more and better disclosures, so mandatory disclosures. And I think a lot of this starts with the mandatory disclosures, i.e. companies, funds, asset managers reporting on what is it that they're doing in sustainability. Once you start having that level of disclosure, then questions will be asked, right? So, what does this data mean? Why are your emissions so high? Why don't you have any minorities on your board? And once companies start to publish targets, the same thing happens, right? Then there's a pressure around taking action towards those targets. So, if you look at the regulatory landscape around the sustainability regulation, there's probably broadly 3 big buckets of regulation out there today. One is around the mandatory disclosures that I just talked about. In the EU, this is CSRD, which means that many companies in Europe will have to disclose and publish data. It's mostly climate data, but some other data sets too. Interestingly, any foreign company with more than 250 employees in the EU will also be in scope. So we've done some analysis on that, and we think it's at least 10,000 large foreign companies that will be in scope. Whether they comply or not is, that remains to be seen. So we have the mandatory disclosures bucket. Then we have another bucket which is largely around product labeling, right? And In financial markets, this is targeted largely at funds, so things like SFDR, for example, or the FCA's fund labeling regime. So that's putting a focus on the investable products, so funds, for example, that are being sold to the market. How green are they? What does that actually mean? How can you be sure that when you put a sustainable label on an investment product, that it actually is sustainable? And then the third bucket is actually regulation for the data providers of ESG data, ratings, scoring, and so on out there. And generally, I think these are all good frameworks. What happens is that it obviously creates a lot of complexity. If you look at something like the EU taxonomy framework, which is a very important piece of regulation in the sense that it seeks to create that common frame of reference, a baseline against which we can all agree, this is green, this is not green, right? There's about 47 different taxonomy regimes across the world in different stages of implementation. We talk about it internally sometimes as taxomania. And this is one example of one regulatory regime, right? So across the world, there's a lot of complexity, which means that if you're a business with global operations, or if you're an investor with a global portfolio, that becomes very time-consuming and difficult to navigate. So while regulation is generally much needed to be able to progress here, it comes with some challenges.
Yeah, it does sound very complex. What role do you feel that corporate sustainability strategies play, though, in shaping the future of sustainable finance? Are they the key to unlocking the next stage?
I think it's a combination, right? It has to be investors really driving that corporate behavior. But the corporate sustainability strategies are really important. And, I think you can think about corporates as generally having three main levers, right? One is their voice in the market, so thought leadership, advocacy, engagement with regulators, and so on, the marketing strategy, so how they project their messaging into the market. The second one is products and services, right? So are we building products and services that are sustainable or help solve for those use cases, or are we just doing what we've always done and perhaps building very high energy consuming products? And then the third one is internal operations, right? So how do you run your own business? And across those three levers, I think companies have a really important role to play and can be very impactful. We certainly think of it across those three levels at the London Stock Exchange Group. Very actively supporting the sustainability agenda in the public domain. My job is to head up our Sustainable Finance Product Development Group, so responsible for building a whole range of product solutions there. And internally, if we think about our own operations, we have a fairly extensive sustainability strategy. It focuses on our people, on our places, so our buildings and offices. It focuses on our travel and also on our supply chain. And I think it's probably worth talking a little bit about supply chain specifically. I know that's a hot topic in many areas, which also obviously feeds into a lot of the regulatory reporting in the Scope 3 capacity. So supply chain is... that is an area where corporates have an opportunity to have a big impact. So working with suppliers, selecting sustainable suppliers, educating. Something that we do at the London Stock Exchange Group is that we often convene meetings, invite, whether it's suppliers or companies that are listed on the London markets, to come in and talk about sustainability issues and how we can think about addressing that.
One last question from me before I come to the room, and that would be flipping things to an investor's perspective. What power do the investors have of driving this agenda?
So investors have significant power in this space, right? They have the ability to work with companies, so the companies that they invest in, whether that's in a private or a public capacity, and really help shape and drive the sustainability agenda. Investors have what I would call also a stewardship opportunity here, right? Particularly if you're talking about the larger institutional investors, they may have the ability to take on a form of what we sometimes call patient capital, right? So being able to act as a steward in the market, guiding corporates along that sustainability journey. But if we sort of think a little bit more broadly, right, providers of capital in the market, whether it's what we think of as traditional investors or maybe also banks, there's a lot of opportunity here around providing sustainable finance products and solutions, so from banks to corporates. That can take the form of supply chain finance, for example, or we see a lot of work on transition finance, which is where banks are providing loans in particular to corporates that are looking to, for example, replace the fleet of vehicles with electric vehicles, perhaps, build a new sustainable energy plant and so on. So I think there's actually huge scope for financial institutions, using that term broadly, to help drive the transition.
Okay, well, let's go to the room quickly. Do we have any immediate questions? We do. We have plenty coming in. So if we can keep these relatively short and sharp, and if we can keep the answers relatively short as well. Just as close to you there, Charlie, please.
Hi, name's Luke Paul-Nielsen from Climate Finance. I was wondering, just picking up on your last point, what do you think are the bottlenecks, or what's causing, why isn't more capital flowing into these sort of innovative, green and sustainable financial products?
Good question. It's not a lack of capital, it's a lack of assets. It's a lack of solid investable assets, right? A lot of this comes back to issues around the data, that unless you can clearly show that this is what we'd think of as a sustainable asset, that flow of capital isn't going to happen. Because coming back to what I said earlier, right, the bread and butter of the investment process is around making those investment and risk decisions based on financial data.
Okay, I believe just to your left there, Charlie. Thank you.
Oh, hi. I enjoyed the talk. I'm just wondering, in your opinion, what are actually the major threats in terms of climate crisis to the finance sector? And do you think people are actually aware of how bad the situation is, the risks involved in practical terms?
Yes, and so look, I think short-sightedness, right? And this is a concept that's been much discussed in the industry. That's a major threat, right? It's just focusing on the near-term quick wins instead of making what sometimes can be challenging decisions for the longer-term good. That I think is a major challenge. Awareness of the severity of the climate crisis is also a problem in some areas, and that's why we need these initiatives around capacity building and education. There's also a little bit of a difference geographically, globally again, right, where some of the large emitting regions and countries are not actually bearing most of the negative impact of that, and that's also a problem.
Okay. They are coming in thick and fast. I believe I'll take two more, I'm afraid, because they came in very quickly. I believe the gentleman in the white shirt was the next one there, just next to you, Charlie, there. Yep, Isa.
Hi, thank you, very interesting. I wonder to what extent, given you talked a little bit earlier about ESG and fund labelling, to what extent the increasing politicisation of that, especially over in the States, with large asset managers dumping some sustainable investments through fear of being labelled one thing or another, to what extent that threatens the London market and generally the sustainable financing climate around the world more generally?
Yeah, no, look, it's a very good question, right? And I think this is what I alluded to earlier, that we're going through a period where some tough questions are being asked, and some of that is a little bit uncomfortable. Fundamentally, I think it's a good and healthy process. I think there's been a little bit of a case of the markets rushing ahead, and we now need to take a step back and really make sure that what we say is sustainable, whether it's assets or funds or investments, lives up to that and delivers. So it's, that narrative and that dialogue is challenging, and I think all we can do is continue to lean into it and make sure that we're doing what makes sense.
Okay, and I think the next hand was that. I think I've gone to them in the order they went up, so I do apologise. Just at the front in the white shirt there. Thank you.
Hi, thank you. Really interesting discussion. My name's Navin Vidana. I'm from Policy Analysis. My question is about regional disparities. Mm-hmm. So when you say that investors and financial institutions can be the drivers of pushing financial markets to sustainability, do you feel that some areas of the world sort of lose out to the investment and opportunities when they don't have the technology or the data monitoring capacities to promote such sustainability?
Yes, I think you're absolutely right. I think that is one of the risks that we need to think more about as a global economy. There is a growing divergence between the global north and the global south, right? And a lot of that is, quite interestingly driven by some of the regulatory frameworks we talked about earlier, where companies and assets in developing markets are struggling to keep up with the expectations in terms of, as you said, data quality, reporting, and so on from investors in developed markets. So I think that's absolutely a problem and something that we need to lean into more.
Because I think yours was the last hand that was left, and you look really disappointed. So Charlie, can we just do one more? I don't like ruining people's days. If it's quick, thank you.
No, it's a quick one. I'm an analyst at Forrester Research, so I do research on data and analytics. I have questions regarding ESG ratings, because we start seeing some of the data providers like S&P dropping ESG ratings. What are the future or the non-future of ESG ratings, ESG scores, and so on?
Yeah, no, great question. One that's close to my heart is the person responsible for two sets of ESG ratings today, the FTSE Russell and Refinitiv ESG scores. So look, back in June, the European Commission launched a regulatory framework for providers of ESG scores and ratings, which we welcome. We think it's much needed. The ESG rating space or scoring space is one that there's a lot of divergence, right? There's a lot of different providers, very different methodologies, a lack of transparency. So I think the future of this space is very much focused on improving transparency, both in terms of your methodology. So how are you assessing ESG? What factors matter to you? How are you calculating that? Where does your data come from, right? Is it actual reported data? Is it estimated data? And then also, which I think is why we've seen some of the changes you alluded to, around conflicts of interest in the business model. Fundamentally, again, I think even though this may be uncomfortable for certain players, it's a really good thing for the industry.
Okay, Cornelia, we've worked you very hard with the questions. Thank you so much for your time. And a round of applause for Cornelia.